Hi friends, welcome back. This video is a continuation from the last video where I discussed about fiscal and monetary policy. In this video, I will talk about the quantitative easing that was conducted by Federal Reserve. I'm creating this video to help you understand some important history of the Fed monetary policy. This will be very helpful to understand the upcoming changes of monetary policy such as the QE tapering and eventual rate hike. The first fun fact on QE is that US is not the first country that started QE. The first country is actually Japan. The term QE itself was first used by Bank of Japan to fight deflation in the early 2000s. The BOJ adopted QE on 19 March 2001. Under the program, BOJ flooded commercial banks with excess liquidity to promote private lending, leaving them with large stocks of excess reserve and therefore little risk of liquidity shortage. The BOJ bought more government bonds that would be required to set the interest rate at zero. It later also bought asset-backed securities or ABS and equities. The BOJ phased out QE policy in March 2002 and stated that QE has not been effective. Global financial crisis 2007-2008. GFC was considered to be the most severe financial crisis since the Great Depression in 1930s. The bursting of the housing bubble leads to collapse of the mortgage-backed securities and derivatives that were linked to this MBS. Lehman Brothers filed for bankruptcy in September 2008 and many large financial institutions were also facing risk of bankruptcy. So US government stepped in to save the market. US QE1, QE2 and QE3. US Fed started the QE program because the Fed fund rate were already at zero floor. Lowering interest rate will stimulate the economy, but Fed cannot push it further down. What can they do? So they were thinking hard and decided to move out of their comfort zone and test something new. Let's walk through the timeline. QE1, November 2008, the Fed started buying 600 billion in mortgage-backed securities. June 2010, bank debt, mortgage-backed securities and treasury notes peaked at 2.1 trillion. Further purchases were halted and the economy started to improve. August 2010, purchases resumed when the Fed decided the economy was not growing robustly. The Fed revised the target holdings to $2 trillion. To maintain that level, the Fed bought 30 billion in 2 to 10-year treasuries notes every month. QE2, November 2010, Fed announced QE2 buying 600 billion of treasury by end of Q2 2011. QE3, September 2011, Fed announced QE3 buying 40 billion per month open-ended bond purchasing program of agency mortgage-backed securities. Because of its open-ended nature, QE3 has earned the popular nickname of QE Infinity. December 2012, the purchase amount was increased from 40 billion to 85 billion per month. June 2013, Ben Bernanke announced a tapering contingent open continued positive economic data. The stock markets dropped by approximately 4.3% over the 3 trading days following Bernanke announcement. This was the event that is known as taper tantrum. September 2013, the Fed was planning over the market reaction and decided to hold off on scaling back its bond buying program. December 2013, the Fed announced it would begin to taper its purchases in January 2014. At this stage, the Fed was still buying, but they gradually reduced the amount of the purchase. October 2014, finally the purchases were halted after accumulating 4.5 trillion in assets. Period between 2015 to 2019 can be considered as period of monetary tightening. During this period, Fed slowly let the balance sheet size to decrease. They also slowly increased the Fed fund rate. It was a very slow process because Fed mainly see this as a normalization instead of forced to tighten the monetary policy due to high inflation. The entire QE program is an experiment because this was the first time it was conducted. In the early years, many economists were worried that the expansion of monetary policy will result in hyperinflation. It turned out that the inflation stayed below 3% in the entire period until 2021. Let's look at the timeline of the key event between 2015 to 2019. December 2015, the Fed announced 25 bips increase in Fed fund rate from 0 to 25 bips to 25 to 50 bips. FOMC officials made it clear that the pace of the increases will be gradual and dependent on the quality of the economic data. December 2016, the Fed raised the rates for the second time and said it foresees 3 more increases in the next year. September 2017, Fed announced it will begin to roll off its 4.5 trillion balance sheet in October. June 2018, Fed indicated that they might have to end the balance sheet reduction process earlier than expected. March 2019, Fed said that it will begin to taper the amount of proceeds it allowed to roll off and it will end the program in September. This means that they will stop reducing their balance sheet. July 2019, the Fed has taken a U-turn and cut rate by 25 basis points, citing implications of global developments and muted inflation pressures. Then the next big event is the pandemic and market crash in March 2020. You guys should know what happened after that. Fed cut a total of 150 basis point interest rates in 2 meetings in March 2020. They also launched a massive 700 billion of QE program. You can see that the balance sheet just expanded quickly from 4 trillion to 8 trillion in less than 2 years. After rounds of fiscal stimulus and also monetary easing, finally we are seeing some improvement in the economy. The economy is referring to the growth statistics and also employment numbers, not the stock market. The stock market has recovered way earlier since mid-2020 after the money printing go. Normalization. After the economy improves, some sort of normalization will happen. Specifically, Fed tapering will happen, Fed may reduce the size of the balance sheet, and Fed will raise the interest rates. This development will come sooner or later. The timing will depend on the development of the pandemic and the quality of the economic data. Next, I will go through a couple of frequently asked questions. Do you consider Fed actions in making investment decisions? My answer is not much. Fed monetary policies like changing the interest rates and expanding or shrinking the balance sheet will have a huge impact to the stock market. Just look at the period in March 2020. Before Fed lowered the interest rate, the stock market was free falling. After the Fed launched the QE and set the interest rate to 0, and the government come up with rounds of stimulus, the stock market just stonks. However, if I'm going to take into account the Fed action, then I need to be able to predict their actions, which is very difficult. How to predict the pandemic situation, job market growth, and inflation? Even if I can predict those, how can I predict the Fed's reaction? Because it is too difficult, I'd rather spend more time on things that is more predictable. For example, invest in companies with strong fundamentals. Next, when will Fed taper the QE? I think they will taper the QE soon, probably by end of this year or early next year. Quite a number of Fed governors have expressed that Fed should taper soon, and the schedule of the tapering may be announced by end of the year. They may taper the purchases gradually till 2022. Why would the Fed like to taper the bond purchase? 2 reasons. The recent economic data shows that the economy is improving. Secondly, the inflation is higher than expected. So if the Fed continue with the current policy, it may lead to increasing inflations in the future, and the risk is that it will become out of control. Will Fed taper crash the market? I think this is the questions that you guys are most interested with. My answer is, I don't think so. The market is still flush with liquidity. Tapering doesn't mean that the liquidity will drop immediately. Tapering means that the Fed is still buying the assets, but the amount is reduced. So even during the tapering period, the monetary policy is still considered as easing policy rather than tightening. What is considered tightening? I will consider rate hike as monetary tightening because raising the Fed fund rate will increase the cost of capital of the commercial banks, and it will increase the longer-term bond yield as well. When will Fed raise rate? You can check the dot plot published by Fed, which maps out the policymakers' expectation for where interest rate could be headed in the future. The dot plot serves as a guide for financial market. You can also check the market implied probabilities on CME website. These probabilities are derived based on the pricing of the Fed Fund futures contract. Here you can see that for February 2023, there's 42% probability that Fed Fund rate will stay at 0%. And there's around 37% probability that there will be 1 rate hike and about 17% that there will be 2 rate hike. Alright, that's all I have on the topics of the US monetary policy and quantitative easing. If you have any questions on this topic, feel free to let me know. I will consider to cover them in the future videos. Alright, invest safe and see you in the next one. Cheers!